Hey, this is Jim Musgrave, and I want to share with you my thoughts on navigating these current economic conditions right now. Obviously, there's a war going on with Iran that's kind of really encompassed much of the Middle East, and there's a lot of uncertainty. And one of the things I'm just going to put into perspective is that we've had wars in the past. And you can go back to the Cuban Missile Crisis, invasion of Iraq, recently where Hamas attacks Israel, and now we have the current situation where about a year later, many of the times that the market's been up, not all the time, but many of the times, and then 3 years later, you can see that 100% of the time that the markets have been in positive territory after geopolitical events. So what happens is when we see these types of things, sometimes political thoughts and have kind of clouded people's thoughts on how they approach their portfolio, and really kind of leads to kind of investing with emotions. And we see this over and over and over again from 2023 to 2025. We've been in a pretty strong market. People been making decent money if they're in equities. But now we've sort of seen a turn of events where things were surprised, they're nervous, they're worried. And for many people, you get to a point where it's like, I can't handle it anymore. I'm going to go ahead and sell. Okay. So when you do that, then the question is, what do you do? Do you just stay in cash, or do you look for other sectors that maybe make you money at that point? Well, here's a piece that JP Morgan put out again. What does an oil shock mean for the dollar, gold, and Bitcoin? And typically, the dollar and gold, for certain, a little bit of Bitcoin, have been sort of a safe haven, have been safe haven assets. And so, again, as the dollar has certainly surged, and again, if interest rate differentials do not narrow as much as expected because of foreign economic outlooks deteriorate, the dollar may not resume its aggressive downward slide. So again, there's all sorts of factors that kind of influence the direction of the dollar as well as gold. Again, gold had a really nice kind of run mostly last year, then it's kind of pulled back. And again, gold doesn't have a dividend. I think having a small allocation to gold or other commodities is a good play. But again, over long, gold is not a great long-term investment strategy. It's typically one of those things that you kind of get in and out of your portfolio given what the markets are doing. Bitcoin is another, asset class that has had a nice run, pretty volatile last year, and has really, really dropped. And so these safe havens are not really doing as well as people would like to have in their portfolio in terms of being sort of a safe haven asset. And just to kind of give you an example of this, here's the S&P 500. You can see that the trend is obviously negative. And we can also see the NASDAQ, the triple Qs, that's also negative. And again, we are definitely in a downward trend. We have not received a buy signal to get back in. But a couple of those positions I just kind of talked to, you can see the dollar right here has had a nice little rally, since the beginning of the year in 2026. But the question is, how long will it rally? And there's certainly factors. If I going to zoom out a bit, you can see that the dollar has certainly been extremely volatile. So again, if you're going to be, buying these different sectors, you definitely need to understand what's moving the sectors behind that. And you need to be using some sort of technical analysis like this to understand when are your entry points and when are your exit points. Same thing with gold. You can see that gold has really had a nice run since 2023. I mean, it was just killing it last year in 2025, but just recent times, we had a big pullback here early February, a little rally, and then it's just been kind of dropping again. Now it's trying to rally a little bit right here, but you can see that the gold has really kind of given up a bunch of its gains since late January, early February. So again, having a small percentage of gold in the portfolio is certainly a good thing. Just understand if you're going to be selling and kind of doing the sector play, again, these sectors are still going to have some degree of volatility. So it's not like cash where you just take that off take the risk off the balance sheet there. The other thing I was going to point out was oil. And you can see right here that oil has just skyrocketed. Well, this is directly because of the war going on in Iran. The question is, if you want to buy oil, you're absolutely buying this at the peak of the market. I mean, it's kind of at hit resistance right here. Could it go further? Sure. But again, the chances are that the conflict is going to be resolved and, things are going to start dropping. Now, my personal feeling is that even if the straits were kind of cleared and oil started to flow, I don't think oil price of oil is just going to plummet down to where it was before. I think it's going to take some time for that to happen. So the other thing I was going to mention too is that if you really get nervous and you want to sell, let's just kind of talk about this for a second. So let's say today you said, I can't handle it anymore. I want to sell. I want to go to cash. Well, you could do that. So the S&P, again, as I'm recording this video, is down less than 7% year to date. The average intra-year volatility in the S&P 500 going back nearly 50 years is about negative 14%, which means that within the January 1 to December 31st, the market on average will drop 14% before it comes up. Okay, so we are certainly well within that range. But let's say you're still nervous and you say, I still want to get out. Well, the problem is if I sold today, then the question is, when do I get back in? Because I'm already selling, on a pullback. And one of the things when you understand technical analysis is that you need to have, buy signals and sell signals. Well, if I kind of go back here to last year where the tariffs hit, the green and the blue line are the 4 and the 8 day moving average. There's different moving averages you can use, but the point is those are short-term indicators. And when the 4 crosses the 8, then you can see that it crossed the 32 and it crossed the 100-day moving average. You can see that was definitely a buy signal. Well, if you get out today, and let's say it drops more, but remember the market's got to come back, and to have a very solid, high probability buy signal, it's got to cross this 100-day or 200-day moving average. So what happens is that, yeah, you're protecting the downside, but when the markets are coming back up, which are completely unpredictable, you're going to be buying in most likely higher than when you sold initially. In that way, and by doing that, you really hurt your performance. And that's one of the reasons why retail investors can tend to really underperform the markets, is that I hate to use this term, but they use their emotions to sell. They sell late and they get in late. And by doing that, they really kind of hurt their performance. So my recommendation in this kind of market is, if you're going to make allocation changes, then make them subtle. Maybe add 5% gold or alternatives or commodities or something like that. One thing that you could also do, there's been a shift from growth to value. Buying individual value stocks or value ETFs is another way to kind of reduce a little bit of volatility. When we go through periods like this, typically those value stocks are going to hold up better than the high-flying technology stuff. But when things start turning around, typically the high-flying technology stuff will kind of surpass the plain boring value stocks. So anyway, my whole point with this is that don't panic. We're still within the length of we're still within the scope of the volatility within the markets, and just having a diversified portfolio is the way to go. Subtle changes is a good thing, and that's why we use tactical management. But do not look at the markets as an on and off switch by going from 100% equities to 100% cash. Huge mistake. I just want to kind of share that thoughts with you. If you have any other questions about this, you can certainly call my office at 301-588-0514. And if you're not on my email list and you're watching the video, you feel free to kind of sign up for our email list. You can do that on our website, mfsadvisors.com, or you can send me an email at jim.musgrave@mfsadvisors.com. Hopefully this helps, and we'll talk to you soon. Take care. Bye.